the armed robbery of 250 million Iraqi dinars from the owner of a currency exchange office in Baghdad may at first appear to be an isolated security incident, but when examined through the lens of Iraq's financial reform journey, its banking sector vulnerabilities, and the speculation surrounding the Iraqi Dinar Revaluation, IQDRV, and the Vietnamese Dong, VND, it illustrates the deeper challenges that Iraq faces in balancing stability, currency sovereignty, and the elimination of the parallel market, which is central to any revaluation narrative, because the fact that such large sums of physical cash are still being carried and moved in Baghdad shows that Iraq's financial system remains underdeveloped, heavily cash-based, and prone to criminal exploitation. And this has direct implications for exchange rate stability and investor confidence, two of the most critical prerequisites for a currency revaluation process. When the Central Bank of Iraq, CBI, and government policymakers talk about strengthening the dinar and aligning it with the real economy, they are essentially trying to push Iraq away from cash-based, black market-driven financial practices into a regulated electronic payment and remittance system. And robberies like this expose the fragility of that transition, highlighting that without robust security, trust in banking channels, and elimination of cash hoarding, the dinar remains exposed to volatility, which in turn delays or complicates any credible path to revaluation. Yet paradoxically, these very crimes also emphasize why reforms are urgent, because as long as gangs can intercept hundreds of millions of dinars on the street, Iraq will remain trapped in a cycle where ordinary citizens distrust banks and prefer to transact in physical cash, thereby fueling the parallel exchange market that undermines the official CBI exchange rate. And this is where the speculation about the IQD RV intersects with the Vietnamese Dong, VND. Since both Iraq and Vietnam are seen as emerging economies with undervalued currencies, positioned for adjustment once reforms, reserves, and monetary stability reach a threshold that satisfies international institutions like the IMF and BIS, but both are also plagued by the shadow economy, corruption, and lack of financial transparency, which delays global recognition of their currencies in stronger baskets. So when an Iraqi exchange office owner is robbed of 250 million dinars, it does not just reflect local crime, it reflects systemic weaknesses in capital mobility, investor protection. The news of an armed robbery in Baghdad, where unidentified gunmen stole 250 million dinars from the owner of a currency exchange office in Al-Banuk, has broader implications for the Iraqi dinar and its exchange rate movements. And while at first glance it appears to be an isolated crime incident, in reality, it reflects deeper systemic issues within Iraq's financial ecosystem, security environment, and the psychology of currency markets. And yet paradoxically, despite such destabilizing incidents, the Iraqi dinar has actually strengthened today, highlighting the complex interplay between perception, government policy, central bank intervention, and global economic factors. Because when cash-based businesses like currency exchange offices are targeted, it underscores the heavy reliance of Iraq on physical cash transactions, rather than fully digitized financial systems, which makes the circulation of dinar physically vulnerable to criminal disruptions. But in response, the Central Bank of Iraq, CBI, often tightens its regulatory grip, pumping confidence into the market by ensuring liquidity and foreign exchange supply, leading to more favorable market rates for the dinar. And today's rise in the dinar reflects precisely that. Investor sentiment appears reassured by the government's swift security response and their CBI's ongoing dollar auctions that stabilize the market. Because while 250 million dinars, roughly $178,000 at the parallel market rate, may sound large, in macroeconomic terms it is negligible against Iraq's foreign reserves exceeding $100 billion, meaning the robbery has no measurable effect on reserves or supply. But the symbolism of the incident, showing that criminals target cash-rich businesses rather than average citizens, signals that the dinar itself remains a valuable and desired asset in daily trade, reinforcing confidence, and beyond Iraq's borders. The global context plays a role too, as de-dollarization trends and Iraq's growing reserves of gold coupled with its agreements to tighten oversight on foreign remittances through the National Bank of Iraq, are increasing international belief that the dinar will maintain stability and potentially appreciate. And in the parallel market today, the dollar weakened slightly against the dinar, with $100 selling at around 140,000 dinars, compared to 140,500 earlier, reflecting the market's perception that despite insecurity, the fundamentals of the dinar are improving, while speculators are watching closely for signals of a larger revaluation, RV, as the gap between the official and market rate narrows. And importantly, such robberies ironically reinforce the push toward electronic payment systems in Iraq, a reform championed by the CBI to reduce reliance on cash, minimize crime, and increase transparency. And the more digital Iraq's economy becomes, the more resilient the dinar will appear internationally, because digital payments tie into anti-money laundering compliance, SOB restructuring, better corporate governance, stronger supervision, and critical enablers like a credit bureau and a beefed-up deposit insurance scheme. The same report also notes that since January 2025, commercial banks, not the central bank, have handled trade finance through their CBRs, with the CBI auditing flows post factum for AML-CFT compliance, a change the IMF directly links to the reduced official parallel spread and rising formal sector usage. Put differently, the IMF is telling you that the official value of the dinar and the effective street value only converge sustainably when banks, not cash windows, intermediate trade and payments in a system that global correspondents trust. That's the precondition for any stable currency regime. And it's why this reform package is so relevant to RV chatter. On the nuts and bolts inside the SOBs, the IMF highlights how undercapitalization from legacy assets, weak risk management, and poor governance at the two giants, Rafadain and Rashid, have long blocked private bank development and hampered credit markets. The authorities plan spinning assets into a Rafadain first entity with minority state ownership, refocusing legacy Rafadain on government accounts, and merging Al Rashid still needs clarity on asset or liability transfers, NPL resolution, and recap sources. But it's directionally aimed at breaking that logjam. Why does that matter for the dinar? Because until the big SOBs stop functioning as quasi-fiscal appendages with opaque books and start operating on commercial, audited, core banking rails, a huge chunk of dinar liquidity sits inert or misallocated. Monetary signals don't pass through to deposit or lending rates, and households and firms hedge in dollars, behavior that weakens demand for dinar assets and keeps pressure on the FX market regardless of what you print on an official rate board. Conversely, successful restructuring, backed by modern core banking systems, real governance bylaws, and a clear ownership policy that limits political interference, expands dinar-denominated credit to the private sector, deepens local assets on the ISX, and raises the opportunity cost of hoarding dollars, all of which support the dinar's effective value over time, even if the nominal peg stays where it is. The IMF is explicit about several of these pillars. It urges issuance of short-term CBI bills to mop up liquidity, so the policy rate bites. It praises the shift to CBR-based trade finance for reducing the unofficial spread. It calls for SOB governance bylaws, robust supervision and regulation, an ownership policy that defines the state's role, and fast-tracked adoption of modern core banking systems. Those prescriptions go straight at the drivers of Iraq's parallel market, premium, compliance frictions, informality, and excess dinar liquidity. In fact, the IMF puts numbers around the macro frame. It projects the exchange rate at 1,300 IQD per USD through 2026,